How is it going, everyone? I got a special guest here, surprise guest actually, who last minute agreed to come on, and I appreciate him despite having terrible internet connection right now and kind of being in the middle of his workday. I appreciate Matt Smith on. Matt, how's it going, man?
Not too bad. Actually, maybe I could rephrase that a little bit. It's been better. Stock market not doing great. At the same time, like my house got hit with a really bad cold, so if my voice goes out, that's what's going on. We've got crazy construction going on, so if there's loud banging, that's what's going on too. So a lot of chaos both at home and in the markets. But how are you holding up?
Holding up well, yes. I mean, this last couple of months, and by the way, let us know in the chat, folks, where you guys are tuning in from, city, state, country, whatever you guys feel comfortable sharing. I'm holding up well. I mean, as we sit here right now, and I was just actually, or we were just talking about this, Matt, just a second before we went online. The last time you were on, we were talking about Tesla Energy. We had an awesome hour and a half conversation, almost 2 hours, I think. And Tesla back then was 1193, I think, in the middle of that stream. So quite different this time around.
Yeah, it is. I mean, everyone was feeling really good then, and macros turned around, tech's gotten whacked. Tesla obviously has as well, but I think it's held up, more stable than a lot of the other tech names out there. So there's that to be thankful for.
Oh,
But
for sure.
yeah, it's a different world for sure.
I mean, that's kind of the kind of saving grace a little bit is if you ever, as a Tesla investor, of course, when a stock goes from $300, $400 pre-split over to $5,000, $4,000, right? If you're talking pre-split numbers. By the way, I just lost your video there. If you were ever wondering if Tesla would be stress tested in an environment, right? I think it's probably safe to say that we've gotten that stress test, and I'm not really entirely sure what else could be thrown at a stock like Tesla. Like Shopify, for example, went from like $2,000 a share to, what is it now, like $300 or something like that. Teladoc's at $30 a share. Lemonade, right? So if you talk about stress tests, Tesla's still sitting here at $3,500 plus a share, pre-split numbers if we're talking. So at least now that kind of uncertainty or anxiety, I mean, the most of the stress test hopefully is behind us, right?
Yeah, I think so. Well, and that's why I think it's helpful when you have a company like Tesla that has turned the corner on profitability. You can come up with a reasonable backstop for valuation with like a peg ratio, or even if you want to just do a forward PE ratio. So I think that's what's really kind of backstopped the price a little bit. You mentioned like Teladoc and Lemonade and a lot of these other companies that have yet to turn the corner on profitability. Well, their only backstop is really cash, and you actually see their cash. A lot of these companies are trading at below their cash values, which tells you that the market is assuming that they're just going to continue burning cash and will never turn the corner.
Right.
So I think with a lot of the tech companies I'm seeing out there, and Fresh Jiva had a really great post on this the other day, which Cathie Wood actually retweeted, saying I forget the exact numbers, but like a ridiculous percentage of like the NASDAQ is trading at below cash value right now.
Right.
So you got like a bunch of companies that are trading at like extreme discounts where, okay, maybe they don't turn the corner and become profitable. But you have to like the upside from here, I think. And with a company like Tesla, you can say, all right, well, let's do a forward PE ratio, and they're growing their earnings at 50% per year. And so at a peg of one, that translates to, by my math, I was thinking like a kind of like bear case share price I was getting when I was trying to stress test this of like $900 per share. So, I think that definitely helps. I mean, in the short term, any crazy thing can happen, and it may even take, months or a year or more to, for the fundamentals to ultimately win out. While there's this, extreme peak in fear. But I think that is the benefit of Tesla, is that, you didn't get the severe like 80% drawdown like a lot of the other names got.
For sure. And I mean, all-time highs, I guess maybe perhaps we were lucky in the sense that all-time highs were pretty much hitting on Tesla when that that growth massacre did hit a lot of stocks, right? But you're right. I mean, first of all, I think being in the S&P fund and having a bunch of tracking funds as well kind of does provide some backstop into buying as well, that other companies don't enjoy, let's say like Teladoc and Shopify and stuff like that. But you're right. I mean, earnings. So, we talk about this year, I think you were projected around. I don't want to put words in your mouth. You were around 15 or $16 for the year prior to Shanghai and everything happening. Does that sound about right, or am I off there?
That sounds about right. I don't remember the exact numbers I had, and I've been playing around with my model so much. I've been kind of like doing a lot of bear case stress tests. So even if I pulled it up right now, it probably wouldn't show
All
my
good.
base case assumption. But yeah, that was. I know for next year, my base case was around $25 per share, and then
Okay.
this kind of bear case I've revised down is like $18. So
Hmm.
I still think it's like 25 is more likely than 18. And the market's only pricing it, I think, like 16 right now.
Hmm.
Um, but there's risk, and so I think if you're trying to say, all right, what's the floor for the price, you want to look at more conservative assumptions.
Right. And sorry, Matt, was that for 2023 fiscal
For
year?
23, yeah. So for
Okay.
this year, yeah, it was probably somewhere around that 15, 16. That sounds about right. It would
Okay.
probably be a little bit lower because you're taking off at
Yeah.
least $1, I think, off of Q2.
Oh yeah, for sure. And Elon, I going back on that for a second. I mean, Elon said that he expects the same number of vehicles somehow to be, made in Shanghai. I'm not sure how that's physically possible.
Did he say made in Shanghai? Because I thought that was the overall company.
Oh,
That was my
perhaps.
understanding
Okay,
of that comment.
that would
But
make
even
more sense.
still,
Yeah.
that seems like a stretch. So I like unless Berlin and Austin are somehow ramping much more than people seem to realize. I don't know how that happens.
Yeah, or Fremont's just apparently Fremont is killing it right now. I mean, a lot of photography and drone footage is coming out of Fremont. Like, they've never seen it this busy, but it's just tough to and put those kind of photos, those kind of anecdotal evidence into any sort of feasible models at the moment, right?
Yeah, it is. I mean, I saw some of those tweets this morning too of Fremont, and I'm like, all right, well, even if Fremont surprises, that can't be more than like
Mm,
25,000 vehicles upside. I don't think
right.
so. In a particular quarter. So does that make up for Shanghai? I don't think so, but maybe in combination with Austin and Berlin ramping, you at least get close. So
Right.
I mean, if they got anywhere near Q1's numbers, that would be an absolute victory, and I could imagine that being a catalyst for the stock. But
Hmm.
clearly, the market is expecting a pretty decent decrease from Q1.
And do we know what's happening with Austin in the sense where I think right now it's just employees being delivered their cars at the moment, right?
Yeah, I think so. So I don't follow the individual like drone flyovers and that sort of stuff as closely as I used to, just because there's so many plants and it's just like folks like Troy Tesla like do it a lot better than I do, frankly. So
Yeah.
I devote my time elsewhere. But um, I mean, everything that I've heard from people that are watching it closely is that yeah, it's a slow ramp, which is kind of what you'd expect.
For sure. Yeah.
Um,
I mean,
Berlin, what I have seen anecdotally though is that Berlin seems to be, maybe hitting on cylinders a little bit more quickly than people might have expected. But I'm
yeah.
not sure to what extent that would translate into a big beat. I haven't
Yeah,
really
for
seen
sure.
any good numbers coming out of there.
Yeah, I see some people talking on Twitter about how Berlin and Austin are going to be massive this quarter. I just don't see it. I don't think that's a healthy expectation to have out of these two new factories just yet. Give them to the end of the year at least to really hit meaningful production, I think, right? So
Yeah, for sure. I mean, it's like when you're in this initial stage of the S curve ramp, it almost doesn't matter. I mean, it's Elon
yeah,
made some comment, and I'm paraphrasing, but a while ago he said something like, a couple of week shift of like the accounting period could have like a drastic
right.
change in the number of vehicles delivered or produced.
Mm,
Um, just because like you're maybe super struggling for the first 4 weeks of a quarter or something like that, and then maybe you
yeah,
you hit some sort of rhythm and on the back 4 weeks, and so you
right.
can, if you drop off those super unproductive 4 weeks and pick up
Hmm.
a productive 4 weeks, that it will make the quarter on quarter numbers look pretty significant. But what really matters, I think, is how quickly do they get to a more meaningful state of production.
I
So yeah,
agree.
like I always like to look forward. Like 2023 for me right now is a good way to
Okay.
kind of think about the market in kind of near term price movements, meaning like in the next 12 months or so, because you're going to have Q3 and Q4 I think will give a good indication of how profitable those plants can be and how quickly they can ramp up. And so if
Right.
they're successful in hitting those sorts of numbers, that's in my mind much more meaningful than how many weeks was Shanghai shut down in Q2, and a lot of these things that
Right.
are just temporary blips right now.
Right. No, absolutely. And I guess that Shanghai blip can just be averaged out over the next 5 years or something, and really just be nothing, right? If in a discount model. So again, as long as it's not a perpetual risk, I don't see it really being a problem, a one-time thing. It is what it is, and it's not only just a Tesla problem, right? Like I love how people love to paint this as just like a hyper local problem on Tesla. But if anything, Tesla has been like the Shanghai government loves providing for Tesla and really goes kind of as far as they possibly can to make sure that they're able to do what they can, right? So I don't see that being too big of a factor.
Yeah, I agree. I mean, of course, it could persist, and you need to be on the lookout for that. If we're still having COVID shutdowns like a year from now, I'd be like, okay, this is,
Right.
maybe a local government issue that we need to, price in a little bit more seriously. If you're going to have like a 2 month shutdown every year, okay, well, let's adjust our expectations for that.
Right.
But assuming that that's not the case, then yeah, I think what we are left with is a government that's very supportive of Tesla,
Mm-hmm.
and Tesla as a company has just proven itself very capable of kind of rolling with the punches. Whether it be supply chain logistics or shortages of key components. I mean, the fact that they like rewrote their software to around the chip shortage,
Right.
that was like amazing. And I'm following like Lucid and Rivian a little bit right now,
Okay.
and they're talking about like all the issues they're having with supply chain, and like their logistics costs are a lot higher than they're expecting.
Yeah.
And so these companies have negative gross margins of like minus 200 to minus 500%, and I'm
Yeah.
like, that would not fly for Tesla. Like,
No, for
so
sure.
yeah, it's they seem to be capable of delivering the entire package around kind of cost management and dealing with this very complicated environment.
Yeah, it Tesla is showing themselves to be like the perfect, like the king pivoters, right? Like, I mean, COVID hit and then they pivoted, the chip shortage and they pivoted. And of course, all pivots going around left, right, and center on the inside of the factories as well, with stuff that we don't even see, of course. It's the only part of the Tesla story we talk about the growth is the question mark really is the scale of the 4680s, and I guess we'll know by the end of this year if they're on track for that for next year. I think Elon mentioned on the call that this year we're not worried about batteries. We have enough batteries. We have them just put away if we need them. It's really about chips this year. Next year, for us to hit that meaningful next level of production, we're going to need 4680s to come to fruition for us at scale. And so, what are your thoughts on 4680s? I don't think we've chatted about that.
Yeah, I don't think we have actually. So I mean, obviously, I like them. I mean, it's like the next leap in terms of cost improvement, most importantly from my perspective, but also a lot more capability that you're getting out of the cell. So the way I think about it is it's kind of like how Ark Invest talks about Wright's law a lot of the time,
Hmm.
and how there's this potential for kind of like a really unappreciated ability to drastically reduce your cost of goods sold over time. And so I guess the way that I think about 4680 is it's a way of them kind of continuing that ridiculous gross margin
Mm.
rise that we've seen over time.
Mm.
I mean, people never would have thought that they'd get to like 30% gross margins, purely on the back of manufacturing, and like they've done that now.
Right.
They don't have a meaningful amount of credit sales or full self-driving like software recognition, and so even if you back all that out, they're at like 28% gross margins
Yeah.
roughly,
Yeah.
which is kind of ridiculous.
It is.
And so then if you fast forward a little bit and say, okay, well, let's say in 2020, let's say like Q4 of 2023, they figured a lot of this stuff out. Fremont is a much smaller percentage of the overall deliveries, meaning that low cost of goods sold, or sorry, that high cost of goods sold coming out of that plant
Mm.
gets relatively lowly, or lowly, I need more sleep, gets weighted relatively more small than like
Right.
say Berlin and Austin, which
Right.
have hit some scale, and they're doing it on the 4680. So maybe
Yeah.
gross margin at those two plants is 40% or something, which sounds absurd.
Mm.
But
Also with gigacastings, right?
in gigacastings, yeah. So like
Yeah.
they're doing all these things which has like Sandy Monroe calls orgasmic, which is like
Yeah.
kind of like hilarious. I'm like, if he's
Yeah.
saying that sort of thing,
Right.
then like me as a financial modeler, I'm like, I don't want to push the needle of like assuming that gross margins can get to 40%. But when
Right.
I see the things that they're doing, I'm like,
You-
it's possible. And in fact, when
Yeah.
you couple that with price increases too, I don't know how they don't get there
Mm.
eventually. So um, I guess it's a very long-winded way of me saying like I think it's just like the margin potential for 4680s on top of it just being a better customer experience, which
Yeah.
will do more to stimulate demand. Um, it's incredibly exciting because it just completely changes the paradigm around what the margins of the company are going to be, and that's could be another kind of leg up in valuation if okay
Mm.
maybe my 25 EPS estimate, which assumes like 30% gross margins next year, maybe
Mm.
that's way too low. Like
Mm.
if they end up posting like EPS of $30 next year, and so they're growing EPS like 100% year on year,
Yeah.
it's like
Yeah.
that has
I know.
very significant implications for stock price.
Absolutely. And it's you kind of hinted at this, like as a financial model, a modeler yourself, you don't want, like, it's almost like unheard, like you putting in 40, you almost feel a little bit silly putting in 40% as your projection, because you're like, and not silly in the sense where you don't see it happening, but silly like for an auto company, we're putting in 40% gross margins. Like this is like 30% is already insane. Like you're putting in 10, 40%, right? So it's kind of incredible if you think about it.
Yeah, like so we at Good Soil Investment, we put together our shareholder letter for Q1, and one of the things we put in there was some analyst commentary in 2017 when they were going through like the Model 3 ramp, and one of the analyst questions was about like their manufacturing efficiency and what they're trying to do to like get their margins up. And Elon's like, he did the whole thing like the factory is the product, and so the
Right.
analyst was like, okay, so you want to be like Toyota, like the Toyota production systems,
Mm.
which was like, little side note, that was like the absolute benchmark of automotive efficiency. Like I
Yeah.
studied those case studies in
Mm.
my MBA program. It's like if you
Mm.
want to be amazing at manufacturing, you follow the Toyota production system.
Yeah.
And like Elon heard that question, and he's just there was like this long pause, and he's just like, no, like no, we don't think that's the hurdle.
Mm.
And so like fast forward, and right now, like I wish I could remember the exact figures, but Tesla's net income margins were roughly comparable to Toyota's gross margins,
I
which is just like insane,
yeah.
like absolutely insane.
I have it.
And
I
so
have it right here. Actually, I'll pull it up for you. So yeah, Sawyer tweeted this out. Toyota had their earnings report. Toyota on Wednesday reported 33% fall in quarterly profit. They posted an operating profit at 3.56 billion in quarter one, below an average estimate of $4 billion. And then I quote tweeted this, I think, saying Tesla was at 3.6 billion operating income in quarter one, so higher than Toyota.
yeah, well, and that's the thing. Like, I see some people talking about like, oh, Tesla's got a market cap bigger than the rest of auto combined, and they're only selling 900,000 vehicles. So
Right.
clearly, that's wrong. Like, people are still putting
Right.
this argument out here, which has been out there for the last decade, and I'm
Right.
like, no, you don't get it. Like, they're growing at 50% per year top line, and they already have best in class margins, and they
Mm.
have ridiculous demand, like they're raising prices right now so that they're actually going to get ahead of inflation.
Right.
Like all these other companies are seeing like failing demand or just such severe logistics supply chain bottlenecks that they're cutting delivery productions.
Yep.
Tesla's expanding, like
Yep.
comparing those market caps is just not appropriate, and the fact that you can
Yep.
um you know come to a pretty reasonable justification of valuation just on a forward PE or PEG ratio, probably more specifically,
Hmm.
is I think indicative of just how like the right way to do it.
And that's not even accounting for the terminal value for a lot of these gas engine, these ICE manufacturers being zero in the next 10 or 15 years, right? Like they're not going to be a going risk moving forward, because countries are quite literally outlawing the new production of gas vehicles moving. Let's say Canada is like 2035. So California, I'm guessing, is pretty similar to that timeline as well.
Yeah, so that's going on from like a regulatory perspective, and then at the same time, you see with inflation and with the commodity issues going on right now, oil over $100 a barrel, and
Yeah.
it's translating to gas at the pump of well over $4, or I don't know, is it liters in Canada? I can't remember.
Yeah, it's Canadian dollars per liter. It's like $2.25 last time I checked. It's, by the way, that's nuts. During COVID, I think it almost hit a dollar during that COVID shutdown originally in 2020. So it's literally doubled. It's nuts.
Yeah. Well, but so then that hurts the math of ICE vehicle ownership.
Hmm.
And so I think for people like 2 years ago, people who did the math and would say, okay, the cap investment or the cost of an EV is higher, but I'm going to make up for that over time with
Yeah.
lower maintenance costs and lower fuel costs. Like that
Yeah.
made sense. But you had to kind of like run a spreadsheet to justify like, oh, okay, actually I can make up for the extra $15,000 sticker price.
Right.
But now I think what you're seeing is people are starting to say, oh, like just my gas cost alone might be
I
enough to
know.
justify that. And then
Yeah.
on top of that, the lower maintenance. And I think what more people are starting to realize now is residual value. So I
Yeah.
mean, the fact that these vehicles, one, they can run way longer than an
Hmm.
ICE car. But two, to your point about ICE being like a $0, like a zero terminal value, say in 2030 or 2035, choose your year.
Hmm.
More and more consumers are going to view that same dynamic for their personal ownership of the vehicle. They'll be like, well, I could buy a new car right now, but it's probably going to depreciate very drastically. But if I buy, an EV, higher
Right.
sticker price, but huge savings on gas, terminal value is maybe I can even break even on it, or it's possible, like what we're seeing now, people who bought an EV 2 years ago, they're now getting a much higher sale price even after using a vehicle for 2 years. So
Yeah,
just like from that alone, you've got 2 years of free ownership, plus you've made some money. Um,
for sure.
so
Oh
that
yeah.
that dynamic, I think people are starting to do that math more than they used to.
Oh, 100%. Even like low, like in my apartment building here, I'm being stopped. It's just, it's kind of weird because obviously well, not obviously, no one knows this, but I'm the only electric vehicle in the whole building. It's about 60 or 70 people or families. And I'm being stopped all the time in elevators or in the lobby, and just kind of known as the Tesla guy for some reason in the building, which is, it's not really something that I welcome, to be honest, because it's just kind of unneeded attention for me, and not because of my channel. By the way, no one knows about my channel. It's just quite literally only because I'm driving this car around. And I'm being stopped and asked about, okay, like what's the sticker price on this? Do they try to haggle you at the dealership when you go, like when you go by? How long's wait times? Like people really know nothing about Tesla car buying at all. Like it's, I tell them you can buy it in 90 seconds. It's online. There's no haggling. There's no sales reps. You probably have to wait 6 months, unfortunately, to actually get your car. And it's, by the way, it's probably gone up in the last month that I've actually talked to you as well. So that part of it sucks for sure. But it just feels like something that I do worry about is oftentimes I'll point these people that need a car in the immediate future, let's say in the next couple months, and don't want to buy a used Tesla, into like a Nissan Leaf, or check out XYZ car that could potentially be on the used market. And Nissan Leafs are decent. We used to have one in the
Yeah.
family. And the problem I have is a little bit is that not all battery management systems are the same. So I almost worry a little bit in 2 to 3, 4 years later after my recommendation, and their battery degradation is massive in a lot of these other EV manufacturers, that later on people will start to realize, oh crap, like EVs don't hold their batteries. Well, Tesla's for the most part do. Even you even have 2012 Model S's rolling around, but a lot of these other manufacturers, like I've heard some stories about Mach-E's that have been on the road for a little bit of time now, um, and they're experiencing huge degradation of their battery capacity. So I worry about these things for the longevity of the EV space. But it's hard to tell people otherwise right now. Like, if people can't buy a Tesla for 7 months, I'm not going to say go buy a gas car, check out another EV. So it's just tough.
Yeah, yeah, it is, and like Tesla can't have 100% of the market share, so I really am rooting for like good alternatives to emerge. But like as an investor in particular, I'm looking at all these like startups and like they've got a very tough road to hoe. And then you look at the incumbents and like, Ford, like you mentioned, has battery management issues. They've got pretty significant software issues as far as I can tell.
Hmm.
And a lot of them are just struggling with the supply chain, and even the ones that have a decent product and can do it at something of a scale, well, they can't do it profitably at a scale, it
Right.
seems. So they're losing money on their EVs that they're producing, and so their ICE vehicle is kind of subsidizing their EVs.
Yeah.
So I really think not more companies need to focus on like a stripped down version of the automobile, because all the complexity of like all the different knobs and everything, and in all the different variants of trim that all these companies seem to be producing, like that is just so much manufacturing complexity that I really think they need to just strip out of there. Even
Yeah.
if some people don't like it, you get the benefit of at least trying to make a profit of it if you can strip out all the kind of unnecessary stuff.
Yeah.
But nobody seems to be willing to take that risk, and
Hmm.
I think it's going to be necessary. Otherwise, you're going to have to just price into the super premium segment, which is already a little
Yeah.
bit crowded,
Yeah.
or you're just going to be like break even or negative gross margins, which is not sustainable.
They're trying to they're definitely trying to run before they can walk, even crawl. But I guess they realize that they have to, because they're so far behind in the timeline of where they should be by now, because they denied electrifying for so long. And by the way, another gripe I have, and we don't have to get into this too much, is this pushing of, we have electrified fleets and they're just hybrids with like 6 kilowatt hour battery packs. I hate that, because almost feel like that's going to be the boycott in 5 years. Us watching this stream and talking about, that hijacking of the BEVs by the hybrids, and they're getting away with all these regulations because they're just making hybrids. It's stupid to me.
Yeah. What was it, Toyota a couple years ago that had that ridiculous tagline, the self-charging EV?
I forget. Was that Toyota?
I thought it was Toyota. Do you remember that though? Where
Was
it
that the
was just a
hybrid
hybrid, but it had
battery
like an EV.
brake regen on it?
Yeah, yeah, it was like some brake regen, and like maybe it had like 10 miles of range or 20 miles of EV range. But they say, oh, it self charges. Well, no, you just have a gas engine. It's a hybrid. Like,
By the
it's
way,
just like,
that's actually a really good segue into the real big question I wanted to ask you about Cathie Wood and ARK Invest buying GM. What was your initial reaction to this, and what do you make of it now, a couple of days later?
like I don't want to dunk too hard on ARK, because like techs just in general had a really rough time, but
Yeah.
I just couldn't believe it. Like when I saw that, she has all these great talking points of, oh, we're focused on disruptive innovation and all this stuff. And I've always had a particular bone to pick with their space investment or space
Mm.
exploration ETF, because it's got names like John Deere and Netflix in there, but it doesn't have Rocket Lab, which is very clearly the number 2 launch provider. So I'm
Right.
like, how like I don't think they have a real great space analyst who's managing that fund. So I've always been slightly skeptical of some of the names that they chose, but
Mm.
reasonable people can disagree on
Yeah.
theses of individual stocks. But when I saw them buying GM, I was just like, what in the world? Like, does GM have like 5x potential from here in your mind? Like, and the only thing I could think is, like, I've heard Tasha Keeney, one of their analysts who specializes on autonomy, basically say something to the extent of like the ride hail, like the robo taxi market is going to be split among a couple different winners, and so maybe they think Cruise is going to be one of those winners. But Cathie, I think, also said that GM's very serious about their electrification
Right.
efforts, but man, I
Yeah.
can tell you, I used to be an intern at GM. I know a lot of people who work there now.
Uh-huh.
That company culture is a disaster. It
Mm.
is so bureaucratic and so broken.
Mm.
And for Cathie to be running, a disruptive innovation fund, the focused on all the winners of the 21st century, and looking to the future, and to be investing in that 135-year-old company, whatever it is.
Yeah.
I don't know. To me, that made me lose a little bit of faith in their in their stock picking, and
Mm.
just what's their thesis. So I don't know. What was your thought?
I'm pretty much the same thing. I originally was really confused, and then some people were replying to all the tweets saying, "Okay, well, this is obviously a just a play for them to get into cruise," which is, you know what, fair enough if that's the only proxy that you can get into investing into cruise. I get it, but then yeah, you're right. Cathie Wood came out and later and said the reason was because they're serious about electrification, which is like, it just kind of didn't make sense. It didn't add up for me enough. And to be honest, like I'm in the same boat as you with ARC. I generally like their research that they put out. I think they put out good research. I think they were ahead on a lot of, and they are ahead on a lot of certain things. And short-term stock price obviously has killed their Wall Street reputation if they cared about it. But I mean, really, it's TBD. I don't get it. It just looks bad, right? From a optics perspective, that you sell Tesla on the same day that you buy GM. And I see Jason here putting that they're different funds for sure. Get it? But remember, people read headlines. And people don't really go into all the depths of everything. They just read, "Oh, Cathie Wood's ARK Invest sells Tesla to buy GM," right? And that's kind of all that people read into it. So optically, it just looks bad.
Yeah, I mean, I do think they're a little bit oversold right now. I mean, I think tech in general is a little oversold. So, I think ARK will rebound and probably regain a little bit of their reputation. And who knows, like 5 years from now,
Yeah.
Cathie may look like an all-star again. And
Yeah.
it's very possible that, she was right on a lot of this stuff. And yeah,
Mm-hmm.
the rebalancing stuff kind of makes sense. I mean, Tesla has held up better than all the other names pretty much in the fund. So you kind of have to sell Tesla to rebalance into anything else. So I don't want to, ding them too much for, just kind of general portfolio management. It's going to just dictate that you sell your best performers and rebalance into the worst performers. But I don't know. A lot of the picks recently have had me scratching my head, like, doubling down on Teladoc and some of those choices. But GM was just like, that seemed like such a break to form. That one was
Yeah.
very puzzling.
Absolutely. And you're right. I mean, a lot of their stocks, people like to say like these companies are dead, or yeah, I mean 80% drawdowns are not easy to overcome, but the companies aren't dead, and the fundamentals perhaps to their eyes are, strong, or if not stronger than ever. So who knows, in 5 years time, this is the beauty of the stock market, is that, it depends on your time horizon when you want to declare someone a winner or not. But I just almost feel like they should make Tesla a bigger percentage than 10% as a part. You just considering that so fundamental to the reason why people invest with them, the reason why people even listen to them. A lot of it, candidly, has to do with their research on Tesla. I would just hope that they would make it a bigger percentage of their fund and then rebalance accordingly. Let's say 20% off Tesla or something like that. So
Yeah, I mean, based on their models, though, they think a lot of these other names will do
you're right.
better. Like, so what do they think? They think Tesla's going to 5x or something like that in the next couple of years. I forget what the exact math is based on today's numbers, but
A little more
um,
than that now. Yeah.
I think when Tesla was roughly, when these other names that are in the portfolio, before they got knocked down by 80%, um, they still had some price target in there that was kind of dictating the weights. So
Hmm.
when they got knocked down by 80%, all of a sudden those looked more attractive. So you don't want to be maxing out Tesla if you truly do believe that your previous price targets still hold. Now, I think there's probably reason to believe that the previous price targets were too rich, and especially in today's macro environment, you need to do things like multiple compression or apply a much more significant discount rate, which is going to really
Yeah.
whack the current value of those kind of long duration growth stocks, which need to turn the table on profitability.
Yeah.
So I'm not sure to what extent they've updated their models to do that, but my understanding, based on listening to their reasoning, is just that they think some of these other names actually have higher IRRs than
Yeah.
holding Tesla. But in my mind,
That's fair.
Tesla's like the much safer bet. So when we're balancing
Right.
our fund right now, it's like we think probably the biggest upside is actually with Lemonade right now because it's been hit so hard.
Okay.
But we think that there's a reasonable chance that we're wrong on that hypothesis and it just falls apart. Because they've got a lot to prove, frankly. Like they've got a lot of like fundamental business issues that they haven't figured out yet. But they're down 80% plus off their highs.
For
But
sure.
Tesla, like, we think, has a very trustworthy backstop to their valuation, and has, call it 3 to 5x potential in the next couple of years if they really execute well on, especially on like autonomy and maybe to a certain extent like a decent prototype for the Tesla bot. So it's like there's a safe play with multiple upside on Tesla, and then there's more of like a riskier play on Lemonade that has even higher upside. So that's the way that we kind of think about it. And so when we're managing the fund, it's like, all right, well, we don't want to bet the ship and potentially lose everyone's money on what looks like a higher IRR to us, but it's admittedly much riskier.
Yeah, that's an interesting insight on how a fund looks at balancing what they're going on. By the way, it's 7:59. We're $10 away from low of day here.
Yeah, it's been going down since we started talking. I got to shut up.
I also wanted to ask you about Q2, the potential tax credit. I mean, there were some rumblings that Q4 they would use this, and you'd have to walk me through this again. But there was some sort of a delayed tax credit that Tesla could put on that could inflate their earnings potential. Could they potentially use that for Q2?
So, are you talking about the net operating loss carry forward?
That's the one. Yes.
Yeah. So that one, maybe for those who are not familiar, Tesla in their early years were every year they lost money, so they didn't pay income taxes. But beyond that, they have a carry forward that they're allowed. So if you lost $1 billion or however many billions of dollars they lost, they're able to carry forward that net loss into future tax periods, and to be able to avoid or to pay lower taxes essentially going forward based on that. Well, in 2019 or whatever, when they first turned the corner on profitability, they kind of their accountants ran some numbers and established a probability that they would be able to use the entire amount of the net operating loss carry forward, and kind of determined that the majority of it, or maybe not the majority, but a very significant portion, it was just unlikely that Tesla would be profitable enough to actually use it in the future. For some reason, they've never gone back and kind of revalued that, which it's somewhere in the neighborhood of $1 billion. I've looked at it very closely, but it's a pretty meaningful, amount. But from my perspective, so I think they're going to, realize that at some point, and it'll be a big gap accounting boost once they do. But from my perspective, I've never taken it too seriously because analysts are going to adjust it out. So it's a one-time issue. It's not even a cash benefit really, because on a cash basis, they're already avoiding paying all these taxes, at least the U.S. federal taxes that this relates to.
Right.
So yeah, I kind of hope they do, because it would at least put an end to this chapter, and the fact that the accountants would then be saying, okay, there's a very high probability now that you are going to be profitable enough to recoup all those past losses and harvest the tax benefit from them. To me, it just seems clear that they've reached that point. But to have the accountants actually do so, and accountants are notoriously conservative, I think that would at least send a good signal and hopefully just put this chapter to bed.
Right. Yes. Okay. Makes sense. So, I mean, yeah, I guess you're right. At the end of the day, it doesn't necessarily matter from a fundamental perspective. I just don't have much faith. Like, for example, when Elon's payroll tax hit in Q4 earnings, when his
It was
payroll
Q4, yeah, it was like 300 something million in Q4.
Yeah, for example, like that's a one-time back out, yet no one all of a sudden wanted to back that one out, and everyone wanted to put on the headlines, right? So like whenever it's detrimental, no one wants to back it out. When it's beneficial, everyone's like, hey, we got to back this thing out. So yeah, from that perspective, I guess it doesn't necessarily matter, but I just thinking, how can we potentially look at Q2 numbers, which are going to be a little bit depressed?
Yeah, the other thing that has been looming out there for a very long time is the deferred revenue balance on full self-driving. So there's roughly $1 billion. I think it's actually a little bit more than that of deferred revenue related to the full self-driving, because it's only like 50% recognizable right now, roughly. So every new sale, they're only recognizing $5,000 of FSD revenue. So whenever they get to the point, and I kind of think it's going to be Q3 or Q4, sometime when they roll out the beta to all of the US, which is the majority of the FSD beta purchases. Whenever they do that, there's going to be a big incremental recognition. So let's say it's in Q4 and they post $1 billion of like deferred revenue recognition. Well, all the analysts are going to back that out, which they should. But at the same time, if you're going to do that, you should also like retroactively inflate the previous quarters, because the previous quarters were artificially held down by the amount that was deferred, and going
Right.
forward the profitability on FSD sales is going to be much higher. And this is something I don't see any of the analysts on Wall Street out there talking about. So when I'm doing my modeling, I very closely track the full self-driving, and okay, when is that flip going to switch? Because when it gets to 100%, there's very meaningful impacts to your gross margins
Right.
when you can recognize the full amount of that
Yeah.
full self-driving revenue in each period. So that's another, I think, kind of hidden catalyst that a lot of analysts are not looking at out there.
Interesting. Yeah. And not to mention that when that does happen, it's because they're way closer to solving autonomous driving, which in and of itself is a huge catalyst, right?
Yeah, exactly. Which is why you want to have your model set up to track FSD separately, because let's say they solve that in Q4. Well, it stands to reason, I think, that take rate is going to go up when people see this.
Hmm.
So if that's true, then you want your model to be able to like run sensitivities around, okay, well, what if take rate doubles, or what if it gets back
Yeah.
up to 25% where it used to be? Um,
Yeah.
or even just like 50% in the US, or like whatever, run your different assumptions. Um, but most analysts covering Tesla at Wall Street, just they don't even look at that. They assume it's all automotive gross, like manufacturing margin. They're not
Yeah.
even looking at the software piece of it, which
Yeah.
Tesla had a note in their Q1 letter saying we expect software sales to be a bigger portion of our gross margins going forward. I'm like, okay, ignore that at your own peril, I think.
Yeah.
when
For
when they're
sure.
actually putting that in an investor letter,
Mm.
to me that shows that like Zach Kirkhorn has a high degree of confidence that this will be a bigger source of margins going forward.
Yeah, it's kind of like buying yourself a taxi cab license, right? In your city, in your city. Which, by the way, I think in Vancouver, I think they go for like 500,000 or something like that to buy a
Wow.
tech. Yeah, it's nuts. Well, I guess every city might be different, but here in Vancouver, you have to buy a license. There's only a certain amount, so you have to buy on the
Yeah, I think New
resale
York City
market.
is the same way. You like buy a medallion, it's like $1 million or something crazy.
It's yeah. So yeah, there you go. $1 million, 500,000, I think here last time I heard. So it'd kind of be like FSD package would kind of be similar in that respect, but even better because now you don't even need a driver in this thing. You can just have it going around at nighttime. So FSD excites me. It's still like anything positively in my brain with FSD and it coming out in the near term. I kind of kind of zhuzh away, like in my brain because I'm like, yeah, but you know what? Let's set expectations more reasonably. Let's not think like it's going to be an imminent 1 or 2 month thing. And I think that's just
For
kind of
sure.
way. I don't feel disappointed. Just that's just my trust issues there. But if that comes out this year, and even in the States only, just wider release, you got to imagine we may see like a cruise type level beta system coming out in limited cities by the end of this year, perhaps.
Yeah, and I try to distinguish in my mind too, the difference between just selling FSD as like a really great ADAS system that maybe has a higher take rate. That's one set of financial opportunities, which is definitely not priced in my mind. But the other opportunity is robo taxis, which is 100% not priced in.
Yeah.
So when I'm doing modeling, I think it's reasonable to assume modestly higher take rate going forward, and that it's going to be like 90% recognizable, something like that,
Hmm.
say in the next year or two. And then you can run a sensitivity analysis on top of that, so it says, okay, maybe then in 2024 or something, then robotaxis can launch, and so you can do evaluation with FSD, and you can do evaluation with FSD sales increasing and with robotaxis, and kind of assuming some assumptions around fleet participation there.
For sure. And I mean, to be clear, there's so much that yet has to be solved. Like, for example, if Tesla is going to do a robotaxi fleet, where are these cars going to charge? Who's going to service them if something goes? Like, there's a lot to fill in the gaps for before that is live. It can happen fast, and Tesla has shown that they're able to put things together quite fast. But there's a lot to be solved here. But that's really not the question. The question is, when does the market believe that it's imminent? That's going to happen, right? And at that point,
Yeah.
you're going to start see front running into Tesla investment by those people.
Yeah, exactly. Because I think this year, like I'm not expecting at all that my vehicle this year will be close to being a robo taxi, right? like they still have done nothing, frankly, on reverse summon. So, the car parking itself.
Right.
Summon itself still sucks, like, very badly.
Mm,
There's just a lot of logistics, and still, like, the error rate is very huge. So it's not very close, in my mind, to being able to remove the driver. But if you see the rate of improvement really accelerate this year, which I think is definitely possible, um, especially, I mean, the fact that they're getting so close to single stack and working on so many of those issues. Once they get to that single stack software platform, the rate of iteration, I think, is going to be much more quick.
right.
So I could very much see a scenario this year where, the car's not close to robotaxi, but the intervention rate decreases drastically. So I kind of think about it. And I don't know if you watched, like, all the FSD videos years ago, but when they first launched, like, the highway autopilot or whatever, it was absolutely terrible at, like, merging on lanes, and, like, it
Mhm.
just all sorts of, like, horrible behavior
Right.
on the highway.
Right.
And that's kind of like how I think FSD beta is right now, like, very
Mm,
obvious mistakes on a regular basis.
mm,
And, probably rightly deserves some criticism,
right.
but that's, like, not an issue anymore on the highway. And I think the same thing is going to happen at a quick pace on city driving. And you're right, if and when that happens, there will be some front running of people that say, okay, it looks like Tesla very well may solve autonomy, so maybe let's give them you do your valuation. Maybe it's $1 trillion opportunity, so you give them a 50% probability of achieving, like, autonomy. So you give them a $500 billion boost in valuation. I could see a scenario like that kind of playing out.
Yeah, and by the way, we're gonna answer some questions. So if you have any questions, we have a couple minutes. We have about 10 minutes left here, Matt, if that's okay. So let's go
Yeah,
through some questions if we can to end off the stream. So toss them in the chat. But I see one here from Farzad. How's it going, Farzad? Farzad saying, "Scenario:
gotta
Is
do
there
the
a
Farzad.
scenario?" Someone clip that. I think that should be your new profile picture, Matt.
I've
Um,
got a shirt just like it, so I should do it. I should really do that quote, put it in black and white.
Oh, you know what? I have a shirt like that too, but it's red. But I could probably put a filter on top. Maybe we should do that after. Farzad saying, is there a scenario where front running of FSD is anything but explosive? I don't see it being a gradual rise. I think it sets a new bottom essentially overnight. That could be 2 or 3 times where we have been trading thoughts. Matt, I'll let you go first.
I I don't necessarily think it will be gradual. So, I think, us nerds in the Tesla Twitter community are going to realize it. But say some new version comes out, and all the beta testers, and presumably it's a much bigger beta pool, gets it and realizes, like, oh my gosh, there's some huge step change here.
Mm-hmm.
I think you could see, like, a huge um, order of, like, options from retail, kind of like we had in 2020, where people are kind of betting on autonomy in a huge run up. But I don't know. My sense is kind of like tens or hundreds of billions of dollars of trades from, like, institutions are not going to be watching these YouTube videos, are not going to be as well informed. And
Right.
so I don't know. I think it may take 6 to 12 months for, other people to kind of catch up, and for, you know, Wall Street investors to sit in Teslas that have this feature, and kind of experience it for themselves. I kind of think it's going to be slightly more gradual than that. But what do you think, Yashu?
I think a 2 or 3 timesing quite quick is very hard for a stock with this high of a market cap, and as heavily as traded as Tesla. Uh, that's probably out of the realm of question. Like 1 month period where Tesla 3x's. I mean, I hope I'm wrong, but I think Farzad, your point is taken. Where in the sense that it's kind of like running like an Olympic sprint, right? Everyone's waiting for that gunshot before they leave, and when they go, everyone's going to go all at once. But no one wants to kind of be kind of jump the gun essentially on that. So I think Wall Street doesn't necessarily care about being the first ones in. They don't want to they don't want to look stupid, if they're wrong about their
Yeah,
thesis on FSD. Like they're more trying to optimize, I think, trying to be correct than they are trying to be ahead of their times. Because when you have something so monumental as as FSD will be for anyone that solves it at any rate, it's just such a step change. It's such a change of model that it's hard to understand until it is online. And then if and then even then, it's probably understated how important FSD will be.
yeah, I agree, because I think it's going to take. some time for the results to work their way through the financial statements. Like even if they solved it today, you got to work through 6 months of backlog to deliver the existing orders. Then you might see FSD take rates start to increase. And from there, it's going to be a long time until you see like robotaxi revenues and margins actually creep through. So how
Yeah.
forward looking and aggressive are people going to be in making their numbers? I mean, to my point of not wanting to look silly with like 40% gross margins,
Right.
I think your Wall Street analysts aren't going to want to look silly like predicting 50, 60% gross margins,
Yeah.
and like billions
Yeah.
of miles traveled on autonomy. So
Yeah.
I agree with you, Yashu. I think there's some conservatism which will limit the potential for a spike, but I hope Farzad's right.
Yeah, for sure. I do too. 2 or 3 times in a month. Oh man, that'd be great. Jordan Q asking, if we're already in a recession, how might that affect the stock price versus a recession playing out in the future?
Yeah, I mean, it's tough to say because like I think we probably are in a recession already. And then the question you need to ask yourself is what amount of multiple compression is warranted from here? So like I went back through my discounted cash flow analysis and kind of plugged in, the new risk-free rate. I think I bumped it up to like 3.5%, which is higher than,
Yeah,
the 10-year is right now.
it is.
But just let's assume that it continues to rise.
Mhm.
And I put in the equity risk premium is really high right now. It's like 5.9% or something like that, which is
Okay.
very much on the high end of where it had been historically. And then you multiply that by the beta of 2 and add in your risk free rate, all of a sudden Tesla's cost of equity is 15%, which is really high. So
Right.
when I was modeling out the business, which is very heavy on the cash flows in like the back half of the decade, say, and especially on the terminal value, like
Mhm.
that takes a very big chunk out of the valuation of Tesla, even though it's so profitable now. Um,
Right.
so I think the question to some extent isn't whether we're in a recession. It's what is the long term
Yeah.
risk free rate and equity risk premium that people are going to be using in these models, and or said another way, like what does PE compression look like? From my point of view, I think there should be a flight to safety during this period, and Tesla is not viewed as a safe asset, but I think it is because it's so well poised to manage this transition to the economy of 2030.
Mhm.
But that's just not the way that traditional finance looks at it.
No. Yeah, and I think we're probably in a recession already as well, albeit perhaps it's just a technical one. If
Yeah.
quarterly growth is like minus 0.5% or something annualized. But I mean, the question is really like you can't have it both ways. Like if rates are so high, let's say 3, 4, 5% in the coming up time, well, then inflation is going to come back down. So there's going to be, a less of a discount there. But then also with Tesla, demand doesn't stop, I think, during a recession. And because of the geopolitical stuff that's happening, I don't think think demand accelerates. So it's kind of like you can't cut it both ways. You can cut it one or the other. But even if you did cut it both ways, I wouldn't worry too much about Tesla's fundamentals in that respect. Now, if we are in a recession, you bet your bottom dollar Wall Street's already front run that.
Yeah.
Oftentimes, it's not going to be like that headline's going to come out. Okay, well, GDP growth quarter 2 was negative, technical recession now, and then we spend a year and a half still trading down because now we're in a recession. It's usually, and I have to go back and look at the charts on stock market versus recession times, but I'd imagine Wall Street would have their ears on the ground pretty well to know what's happening.
Yeah,
So
and that's like to what extent has the front running already occurred? I mean, you look at the Nasdaq and growth stocks in particular, and it looks pretty well front run. Like, how much of a discount to cash should companies be trading at, right?
for sure.
I just don't know how much more room there is to go down. But I mean, the Nasdaq though, it's only gone down like roughly about the last year's gains, maybe a year and a half, right? So
Yep. Down about
there's
25% since
it does
November.
seem reasonable that, maybe it gets down to, I don't know, say 2019 levels or something like that, which would be a significant move down from here.
Right. And that would be so you mean like COVID crash times or
Yeah, like I was just looking at this chart the other day, and it's
Mhm.
it seems like such a steep drop, but when you look at it, like just compared to how high we are above COVID, like even pre-COVID levels,
Right.
which was seemingly at the time like a pretty juicy time.
Right.
Um,
We're about 82% higher than COVID times sitting at right now.
ex- exactly. So I'm trying to, um, you know, temper my own bullishness to some extent by saying, okay, like we've come up very high, very fast, and so there's a reasonable scenario that pans out that we get back to those types of levels. I think if companies maintain earnings power, then that's not going to happen, but it's possible that they don't.
I also think, though, there's a degree of there's going to be a lot of companies that just die off during these
Yes.
times, right? And there's going to be a concentration into stronger companies that survive and thrive during these times. It's just the name of the game, right?
Yeah, I
So,
completely agree. It's the forest fire thesis.
right, yeah. Dan asking a funny question: do we see a factory bot this fall? Not the full AI version, though.
I'm going to claim Elon time here, and I'm going to say it's fall of 23.
Okay. Hey, I mean, I can live with that if it's only a year and a half away. Uh, I'm going to push into 2024 for the bot. Again, I'd like to be proven wrong, but I just think let's solve Cybertruck. Let's get that out. Let's get that rolling, and then let's talk about the bot. Probably, that's my
Yeah, I mean,
feelings
we're
on that.
still waiting on Roadster. We're still waiting on like
Yeah,
Solar Roof really reaching scale. We're still waiting on Semi. We're still waiting on, so many things. Cybertruck, obviously, like you said. And so there's just a lot that hasn't been delivered on time, and so I think it's just prudent to apply a bit of a
yeah,
discount there.
for sure. G's asking, do you think it will take years for the market to come back? We are all inflated with the printed money. Do you think the comeback period here is months, years? What do you think, Matt?
You know, I I don't know. I mean, I think it's if when I look at the broader like indices, what I do think is going to happen is what you said, where there's going to be winners and losers. So, I think the overall indices, maybe they're looking flat or down even, but I think there's going to be some really stellar outperformers during that time period. So, what I'm trying to do, what Emmett and I are really trying to do right now is just like stay focused on the winners, because like we're not going to predict macro. Nobody can really predict macro. Um, but I think the best you can do is try to pick the winners. And so then even if your winners are, down, say like 10% through the rest of the year, or 20% or 50% even, well, if the market is down more than that, because there's more losers in the indices than in your own portfolio, then you've done well. So that's kind of what we're thinking of. Just go back
Mm,
to the individual company basics and
yeah.
focus there.
For sure. Yeah, it's tough to say, right? With indices versus certain stocks. I think that's why for what, a couple months now, I've just kind of stayed away from shorter term option plays, like 2 or 3 months, which is kind of what up to 6 months out is kind of what I'd usually been trading. But since the year just been so busy, I've just kind of stayed away because I think there's still, I think in the next couple months here, still uncertainty. Maybe we just trade flat. By the way, I think trading flat here would not be the worst case, because
Yeah.
I mean I think there's still more upside on stocks than there is downside potential on good companies. Especially with, of course, does it take a genius to say, with the drawdowns that we've seen, of course. So, it's tough to say. I would say years would be tough. I mean, after the '01, after the dot-com bubble, it did take years for that to come back. But after '08, even, that was a systemic problem that we had with institutional risk, with the '08. So I don't think it's comparable. But I think what we've kind of just seen is all of the fat in the market, the excess liquidity, just be drained out. And right now we're just seeing like a leaned out version of the stock market. But your point stands, G, where it's like, where's all this money gone? It's going to have to come back at some point or another, because money likes to grow and make returns, and to be borrowed and to be lent out, and to be used and to be credited. So perhaps what we're seeing is just a short term putting money on the sidelines scenario. And in the next 6 months, we see a gradual stepping back. Because this is my general thesis right now with the Fed, is they're going to increase rates. They're going to continue to increase rates. If a recession hits, well, how do you continue to increase rates at the rate that you were going to say during a recession? It's just not going to happen. So either there's going to be a pausing of rate hikes there, or, I mean, believe it or not, maybe we even see rates coming back down towards the end of this year, in next year. Because with a recession, depending on how bad it gets, I don't see them continuing to raise rates in the name of inflation. If we're in a recession, so it's a hot mess, the whole economy right now.
Yeah, it really is. But I think it's going to put more pressure on upward pressure on truly disruptive companies, though. Like solar companies should be doing really well with oil price so high, right? And EV companies too, with gas prices so high. So I think there's going to be a lot of opportunity to kind of undercut commodity price pressure and inflationary pressure.
For sure. And Matt, I'll leave you with this last question here. And for everyone in the chat as well, throw your Tesla closing price guess in for today in the chat. Matt, I'll give you a second to think here. Price is Right rules, remember everyone. So you have to be at or under to qualify for the virtual Juju prize, which I will try to hand out after, or I'll tweet it out for who's won. But Matt, I'll let you go first as the guest of the show.
All right. I'm gonna say we've got a modest rally into close. I'll say 773.42. Just going random numbers there.
773. Okay. Wow. I mean, I take that 770. Let me just map this out. Where is this? 773.42. I'm just gonna draw a price line.
We've been down so much since you and I have been talking. I thought we just reverse some of that out.
I think that's right. I'm probably gonna eat a couple oranges after this stream.
I want to say 761 sitting on Tesla here. I've never had the chance to go for it.
Boom. There you go. You heard it here. Hey, that's a good luck charm right there. What you've just done. I'm gonna guess 780 to end the day.
780. All right.
Yeah, I'm gonna go high. Remember, 787 is Hive Day, and 762 sitting on Tesla right now. So I'm gonna guess 780. I'm gonna draw that out as well, just so I don't forget, because I'm probably going to. Awesome. And I see some chats here. Some people are really low, 750s. Some people are really high. So I guess we'll find out. But Matt, thanks for coming on such short notice, on a random notice, and happy Friday to you. And hopefully we can do this again with Tesla back into the 4-digit club soon enough.
Absolutely. Thanks, Yashu. This was fun.
Take care, everyone. Thanks for everyone in leaving comments. I will try to save as many as I can. I'll tweet out the winner later. Take care, everyone. Have a great, wonderful weekend. Put away your technology, do your meditation or whatever to deplug and to have a stress-free weekend. Take care, and I'll catch you next week.